Hello and welcome to this conversation on BloombergQuint. We've got the national income data that's come in today with a bit of a surprise. Let's split the discussion into two parts. So the headline number, if you're looking at the GDP number at 7.1% is what was expected. Where the surprise has come in is in the quarterly numbers, and the quarterly numbers based on the gross value added basis, that is a second way of looking at this national income data, suggests that there was a steep slowdown first in Q3, but more specifically in Q4, bringing growth down almost to the 5.6%, I think was the precise number for GVA growth in the fourth quarter. Madan, Sabnavis, Chief Economist at Care Ratings, is joining us to help us understand this data. Thanks so much, sir, for coming in. I want to split this because I think there are various parts to this data. So let's look at the headline annual growth number. That is more or less expected and was anticipated?
Yes, it's exactly the same number which they had even with the old methodology.
Yeah.
Because this new methodology was supposed to incorporate the changes on account of the IIP and the WPI base years being changed. So therefore, some kind of change was really expected. So this seems to be quite magical that 7.1% number still remains. But as you had mentioned, the quarterly numbers seem to have changed quite drastically. And not just changed drastically, but they give a different impression about what really happened in the quarters. Because just to go back, I think when the third quarter results did come out, we actually got the impression that the third quarter was a good quarter because growth was around 7%. And it was one of the better quarters compared to the first and second. So therefore, we had this impression that probably the demonetization process did not really have an impact on GDP. But today, when we get to know that in both Q3 and Q4, there's been a distinct slowdown in growth in GDP. So one would tend to believe that the effect of demonetization was far sharper than what we had expected. And more importantly, the kind of recovery which probably the early corporate results give us to believe in the fourth quarter is not really borne out from this data.
So let me now start breaking it down. So quarterly numbers both on GDP and GVA basis are telling you that Q3 and Q4 were slow?
Yeah, absolutely. Q3 and Q4 were slower than Q1 and Q2.
Okay.
So that's a period where we would typically try and relate it with demonetization because that was the major event which took place. Because if you remember, if you go back towards say September, October, we didn't get a feeling that consumption had actually picked up.
Yeah.
And I think the clearest thing was Flipkart, Amazon, the kind of sales which they had and what really picked up in a week's time was quite amazing. Yeah. So therefore one had this feeling that the major lacuna in the Indian economy, which was consumer demand, was something which had gotten reversed. But on account of this demonetization move, we saw that on the consumption side, there was a major setback for it.
Yeah. So I mean, if I'm just going to stick to the GVA numbers from here. So the GVA numbers are telling you that growth in the fourth quarter was significantly slower than in the third, exactly. Right? But there is a base effect potentially that's playing out because the fourth quarter of last year had an 8% plus growth.
See, base effect does explain this phenomenon partly. But we cannot say it's only a statistical phenomenon that growth has come at 6.1% in the fourth quarter. Because it's one thing to say there's a base effect, there's a WPI effect which has also come into play, which has actually pushed the number down. But the other thing is that I cannot have such a big difference, such a sharp fall between Q3 and Q4. So a large part of it is because of the demand which should have been recouped, or what we thought was being recouped in the fourth quarter, which hasn't quite materialized.
And even the sectors seem to link into the demonetization story because the slowdown has come into sectors like manufacturing, but most importantly construction, which saw negative growth on a GVA basis in the fourth quarter. Finance was much slower as well, right? So all of those are the obvious...
Yes, exactly. Because if we are talking of manufacturing, I think that's the first impact affected both on demand side, which we are talking of, as well as the fact that there's a large proportion of the unorganized sector. Yeah. So I think that segment did definitely get impacted on account of demonetization. Second, if you look at something like construction, I think that's the direct impact which is coming from real estate. Yeah. So there should have been some kind of compensation coming from government spending, because I think the government is another major spender in this particular area. But I don't think it had managed to make up for the kind of loss of output which we had in the private real estate space. And then again, if you look at the linkages which come to say a trade, transport, which is directly linked to what happens in manufacturing and construction, there was an impact out there. And the entire banking sector, though I'm quite surprised that the financial sector is showing a very low growth in GVA in the fourth quarter, because if one recollects, I think in the last fortnight of March, there was a major increase in both bank deposits and credit. what was 4.4% credit, I think it crossed 7.5% or so. And that is what really goes into the calculation of GDP, because they look at the total banking business. So again, out here I think it's probably the base effect or the deflators.
Or the last fortnight may not get captured, right?
No, it gets captured.
It gets captured.
Out here. But I think out here it's probably the WPI numbers being higher, which has gotten it scaled down, because here we're talking of something which is available at current prices, which is scaled down to constant prices through the WPI, which tended to be higher in this particular quarter.
Yeah, so I think that's the other sort of conundrum that people are discussing right now, is that at current prices, the slowdown doesn't seem to be that sharp. So that is what, again, a WPI impact?
It would be the WPI impact. It's primarily the WPI impact. And I think this is something which we will probably have to live for with another couple of quarters or maybe another year, because this new concept of WPI is going to tend to affect all these sectors periodically.
Okay.
Because it's not just the headline number of WPI, but the different components which are there, which would be having a differential impact depending on which sector we're dealing with.
Okay. So the narrative that is emerging from this set of data, sir, is that there has been a slowdown in growth this year. First half was stronger, and then in the second half we have seen a dramatic sort of
this sounds
shift.
actually logical, because if we had met 2 months back and we were discussing the second advanced estimates of CSO, it looked fairly bizarre, because we had a situation where third quarter seemed to be showing an acceleration, and therefore we logically thought that, okay, the fourth quarter has to be better than the Q3, because whatever was lost on account of demonetization would be partially recouped in the fourth quarter. But now the thing looks more logical, first half being strong, the second half being weak.
Okay, and this is actually in keeping with other data points. I mean, whether it's IIP that we know of, plus what we are hearing around, even core inflation actually, because core inflation has also started to come off in the second half of the year.
Absolutely.
So all of that sort of ties in together.
Right.
Okay, then that brings us to the next question as to why then are we moving to slightly tighter monetary policy stance, because core inflation is coming off. We've seen growth numbers starting to come off. Is this reason for the RBI to rethink?
See, there is a very strong reason if you go just looking at the numbers and you say, okay, the MPC is supposed to be targeting the consumer price index, and if CPI inflation seems to be in the region of 3 to 4%, there's no reason why the RBI should not be lowering interest rates. But if you look at RBI and the way in which it looks at inflation, I'm sure even the other members of the Monetary Policy Committee will be looking at these aspects, is that you need to see what is the future inflation likely to look like. Now, last time when the RBI met, it was felt that while overall the headline number was down, there was no reason for one to be suspicious that it would go up. There was some concern in terms of oil prices. There was some concern on the monsoon, even though the IMD had given some kind of indication that the monsoon would be normal. And the third was, of course, the GST. And I think they also spoke in terms of the pay commission recommendations, especially in terms of the HRA allowance, which gets into the CPI number. So today, if you look at it, it looks weird. I think the OPEC is worried that prices are coming down, they're not going up. So I don't think that's going to be an issue. The monsoon looks to be fairly well. It has begun fairly well. So I don't think there's reason for one to suspect that there could be anything awry happening in the next few months, which leaves actually the GST and the HRA component. Now, if you look at the non-core inflation, the non-food inflation or the core inflation part of CPI, so even though it's been sort of cooling down, but it's definitely been in the region of 4.5 plus for various elements. So this could be something which the RBI may like to pause and look and see how exactly it behaves in the next few months. And in terms of GST, I think even though prima facie it looks like that the impact would be more or less neutral, I think given the fact that when we get a new system of taxation, where Indian companies traditionally do not pass on the benefits to the consumer. We've always seen that when your toothpaste comes down from 100 rupees and the tax comes down by say 5% or 4%, the price probably comes down from 100 rupees to say 99 rupees 50 paise. So the full transfer doesn't really take place. So it's quite possible that the inflation impact may be positive in terms of being higher to begin with before things actually even out. So this could be one worry of the RBI. And the second is, of course, in terms of the HRA allowance, because we feel that the way in which the rent gets calculated in the CPI, it's based on the official numbers on the HR. So even though there's no monetary transaction, the very fact that the numbers go up could be making this CPI number look high. And I think given this current situation where there's not much investment taking place, there's not much demand for credit. The demand is low because of the consumption is low, and second, the NPA issue is also a serious one today. So there may be no hurry for the RBI to really lower interest rates at this particular point of time. So to my mind, if you wait for maybe another quarter or so, you wait for September, October, really take full stock of the situation, and then you can probably take a decision to lower interest rates. Because today, if you see, even investment seems to be fairly down.
Yeah, and I want to get to that in a minute.
Yeah. And when we're not seeing any interest being shown by private players in investment in manufacturing because we have surplus capacity, in infrastructure because funding is still an issue, and I don't think anybody would like to get into infrastructure at this particular stage. So there may be no pressing need for one to actually lower interest rates today. It's more kind of a psychological thing. Because if you do it, even in the past, in the last year, we saw that when you lowered interest rates, there was no real pickup in credit. So merely by lowering credit, I think we tend to look at it more from the supply side. We're in the corporate world, so we always say that you lower interest rates, it's good for companies. But merely because interest rates come down,
they're not going to put up capacity that they don't need.
Or even we don't go and buy a house or an automobile merely because interest rates have come down by 50 basis points.
Absolutely.
So I think there is good reason for the RBI to hold on, and my own sense is that the RBI will probably wait for at least another policy, if not two, until we come to September, October, before they take a decision on interest rates, if everything looks the way things are moving.
So what is the analysis, again, based on this data, on the two big components of the economy, or three, government consumption, personal consumption, capital formation? It seems like pretty much throughout the year, it's been the government spending that has kept us going. Personal consumption was strong, but this quarter it has come off a little bit.
See, actually, the thing is that if you're looking at who really has the power to spend today in the economy, so you mentioned the three parts: there are households, there are companies, that's the corporates, and then there's the government. If you look at households, we are still grappling with a situation of incomes not increasing commensurately with what one would like it to happen. And we've been afflicted with high inflation in the past, food inflation, so there's been less money left for buying consumption goods. And just at a time when it probably looked that we could do it last year, we had this thing of demonetization where consumption was pushed back to a large extent, which I think is something which is going to recover. But then given the way in which consumption cycles move in India, it's more likely to be during the festival time, during the post-harvest time in the rural areas. So any kind of turnaround is more likely to be September, October onwards, not current in the present phase. Then if you're looking at say investment, so as I mentioned earlier, industry has no reason to invest.
To invest right now, yeah.
And in terms of funding, the banks have to sort out this problem of NPAs.
Yeah.
So I don't think our financial sector is in a position to actually lend money for infrastructure purposes. The government and RBI have come up with various measures like partial credit enhancement. I believe there's not been a single case which has been taken.
I'm not surprised.
It's not surprising. Simply we're talking about reforming the debt market, but we should remember the debt market only accepts paper which are AA and above because there won't be investors for it. So there's also a case of funding. So I think until this whole financial environment improves and people have more confidence in the financial sector, only then do I think that lending will pick up and investment is going to take place.
So investment may not even be a FY18 story, it may end up being an FY19 story.
It could be a FY19 because I think it happens something which happens gradually, doesn't happen
in a big way.
That fast. And if you look at government also, it's a peculiar situation because if I break it up into two parts, we have the central government and we have the state government.
Yeah.
But the central government has been fairly aggressive in terms of its spending. But we should realize that if you look at the budget numbers, for example, the capex is supposed to be around 3 lakh crores. Okay. Take out 1 lakh crores, which is on defense, because that could be a large part, could be imports. It may not really be adding to domestic demand for goods. So if I talk of 2 lakhs crores and I'm talking of a GDP of around 155, 160 lakh crores, it's a very small amount which can actually drive the economy. So to the extent that the government is able to meet its commitment, which I think this NDA government has done in the last 3 years, that you budget for a certain number and you're able to meet it, I think the government is on the right path. But if you look at the state governments, now they have run into a problem on account of the Uday bonds.
Yeah.
See, earlier there was a commensurate amount of capital expenditure coming from state governments. Now today what's happened is that when we've had the Uday scheme floated, state governments have been told, okay, we are going to forgive you for your fiscal deficit numbers, they can go to 4.5%, it's fair enough. But what happens is that the debt gets added to your outstanding debt, so your liabilities go up. Yeah. And now they're concerned about the debt to GDP ratio. They're also
and there's
concerned
pressure on
that
them as
interest
well.
Payments are going up. So invariably what we have seen in the last year is that state governments have tended to be less aggressive when it comes to spending on capital expenditure, which is quite logical also. So I think state governments will also have to sort out this particular issue, and it's not going to come forth as easily as that from the central government. So I think on the whole, that's why we feel at least at CARE that GDP growth will be higher in the current year.
Yeah,
if monsoon is good, consumption picks up, the government spends whatever it has to. Maybe we move towards 7.6, 7.8%
on GDP,
but it's still lower than 8%. And I think that's the important part for this entire GDP story that there has been a perceptible slowdown in growth. Now we can blame it saying that the base effect, we can say the new methodology, IAP numbers, WPI numbers, but the fact remains that growth has slowed down. And you try and look at what the World Bank is saying, they're also not really looking at an 8% growth number anytime soon.
So it is, I mean, so that's the real story.
It's going to be a very slow pickup.
It's going to be a slow pickup. Thank you so much, Madan, for coming in. Appreciate it. Thanks for watching BloombergQuint. Keep following this story on BloombergQuint.com. We've got a lot of analysis coming up on it. Thanks for watching.